starts getting colored in. And then we have the closing price right here. Now, obviously green for up and red for down. So we know that this candlestick, this period in time is a green or an upward move. This is the open, this is the close. We know that it is an upward move because of the color of the candlestick. So we know that this is the open. We then also have the high during the trading period and the low during the trading period. So really important, basically, this is the open. Then what happened is that sellers came in and drove the price down all the way to here. Then in the same time period, buyers came in and pushed the price all the way up to this level. And then sellers came in once more. And at the end of the time period, that is where the price was. And so that is the close. It was above the open. And so we give it a green color. It's exactly the opposite for a bearish candle. We know this is the open because it's a red candlestick. So it's colored in here, the open, this is the close. During the time period, buyers pushed the price up to here, sellers pushed it down to here, but actually it closed around here. We can use the colored in part or the body and the wick to tell us a lot about a period of time and what traders are doing. You might have heard of candlestick patterns. There are many patterns with candlesticks and they tell us something about the trade. This is a hammer pattern because it looks a little bit like a hammer. Well, this is a bullish pattern in this scenario anyway. What happened essentially is that sellers pushed the price all the way down here. Buyers came in though, pushed the price up. And actually at the end of the session, the price and the closing price was higher than the entry price or the opening price. During the session, sellers came in, buyers pushed the price up though. Is this going to happen tomorrow or in the next period, in the next candlestick? It may do. And if it does, that means we can use this to enter into some trades. Where's the high, the close, the open, and the low? This is the open, of course. It's a green candlestick, so we know that the start of the body is the lower line. Where is the close? That is this portion. It's a green candlestick, so we know that the price rose during the time. Whereas the low on this candlestick, it's right here. And of course the high, there's no wick at the top. So during this time period, the high is actually the close. How do we trade this tomorrow then? Well, if buyers during this time period are pushing the price up, that could continue into the next session. Maybe tomorrow, if this is a 5-minute chart, then it will be in the next 5 minutes. And you can see that you can read this candlestick chart to say, actually, if these buyers are coming in now, it may carry on into the next session. I can buy and try and get a rising price. Shooting star, this is a bearish pattern, complete opposite of a hammer. It's a bearish pattern. It shows you that buyers drove the price high during the session, but sellers won and the price fell lower and closed lower. Will this continue tomorrow? If it does, then sellers are winning and they will push the price down. Whereas the open, close, high and low, this is obviously the open because it's a red candlestick. So we know the higher line is the open. This is the close right here, the end of the body. We have the high right here of the session, and we have the low is this tiny little bit here. This is a bearish sign because buyers drove the price up, sellers came in, drove it right down and even lower to a red candlestick. Bullish engulfing pattern, super important this one, and we use it all the time to go into trades. This is a bullish pattern, it's a bullish candlestick. It shows that the bullish or up move actually engulfed the previous down move, and this is something that traders will use all the time. It represents a strong reversal in the trend for the candlestick previously. Let's zoom in right on here then. So what is it? We can see that this is the previous candlestick, a downward move. We know it's red, so it's down. But what happened in the next candlestick is that the momentum changed significantly. Sellers came in and pushed the price down here. Not only did buyers come in and push the price up, it engulfed the entire previous move to the downside. That's very bullish. It means that there's a strong difference and a strong reversal of that trade to the upside. Conversely, we also have a bearish engulfing when a move to the upside in a green candlestick is completely engulfed by a red candlestick. When you're trading candlesticks, always look out for bullish and bearish engulfings because it will represent a strong reversal in a trend, and this will obviously impact the way that we trade. Let's come back to the Binance chart then, and let's have a look at some candlesticks now. We can see this is a huge bullish engulfing right here. You had a downtrend, huge bearish engulfings right here, bearish, huge bearish sell-off. But then this session, look at this session, what a great session. If you'd have got in right here, this is a huge bullish engulfing, way up. Now what you'd say is, well, if this session was up, then buyers are coming in and they're having to pay ever higher prices because there aren't enough sellers, maybe that will continue. And if you'd have gone in long right here, then after a couple of days of sideways trade, you would have made a huge amount of money on this upswing. Bullish engulfing right here. Again, this is a bullish engulfing. It does engulf the previous candlestick. So you can look for these, again, a huge bullish engulfing right here, a big down move, and then a massive up move as well. So you can see these both on the bullish and bearish sides, but they do represent a strong reversal in a trend. So let's look at candlestick charts then. They give us price data for a time period. Traders use these all the time to anticipate future moves, and they show us possibly bullish and bearish ways of trading. We can use them to anticipate and form possible entry points for our trades. Coming on to chart patterns then. Chart patterns are used in conjunction with candlesticks. They give a longer term analysis of market movements. They can be bullish and bearish, and they are used with day trading and swing trading, and we know what those are now. This is a classic chart pattern. It's called a double top. So this is a bearish pattern actually, because what it shows you is that buyers keep coming in, but they keep getting batted and swatted away. And what that means is that sellers are around and the price actually may fall down. Buyers are unable to push the price higher. So we can see the momentum of the chart right here going up. We can see at this point though, buyers run out of steam. Buyers are trying to push the price up, but sellers are coming in and the price does not move upwards right here. So the price moves back down, but then the price moves up again. This just means that buyers are coming in again, buying some cryptocurrency. So we're pushing the price up again. Once more sellers come in. So the move is rejected. There's obviously a lot of sellers in this market, and what that could mean is that the sellers are here and the price will fall off. So this is known as a double top, which is a bearish pattern. Double bottom is the complete opposite. It's a bullish sign. Sellers are coming in, but the price meets support at this level. Sellers can't push the price any lower because there are too many buyers buying up. And so what happens is you get a small run up, sellers come in once more, and again at this same price, buyers are mopping up at this price, and so it can't be pushed lower anymore. And so what that may mean is that there are more buyers than sellers, and so you may get an upward move in the price. And this one is great, ascending triangle. It's a really great setup and one you should watch for. Let's try and analyze this one. What is going to happen here? This is different from the double bottom and double top as it takes place over a longer time period, but you can see supports right here and resistance right here. You can definitely see this pattern playing out. First thing we need to do, what is the trend? Where is it going? You can definitely see that this is an uptrend. The support and the lowest price is actually increasing. The highest price though is standing around this level. So when the price does come up to here, sellers come in, push the price lower. So we can see these moves here. This is an upward move, then you get the sell-off. Upward move, then you get the sell-off, upward move. But what you can see is that the downward moves are moving up in price over time. Then we get another upward move here, and the downward move is even smaller. You can see how the price is really going into this wedge or the end of the triangle. It's telling us that the price is becoming ever more constricted. Buyers are not willing to pay above this price, but they're having to buy crypto at ever higher levels. They can't get crypto down here anymore. They're having to pay around this level. So you're getting this wedge pattern, and this is used with breakout trading. When this happens, when this consolidation happens, you may just get a breakout because the supply is obviously constricting. There are fewer and fewer sellers, and so buyers have to pay ever higher prices. And what might happen is just a whoosh out of the triangle, a massive breakout, and that's what we want to trade. Charts never trade in a straight line. It's just not going to happen, but they trend, and it's our job to try and anticipate this. Highs and lows are important. We can see these. Consolidation is important. Consolidation of price. You can see the price range is narrowing. Super important as a trader to try and anticipate this. Higher highs and higher lows is bullish. I'm going to get onto that in a second, but you have higher lows. The lows are ever going higher, and that is a bullish sign. This is going to precede a breakout for sure. Let's get onto chart patterns though before we get onto trends. Chart patterns show us if buyers or sellers are winning. We can use these to anticipate the future. Patterns are elusive though and very hard to spot. Patterns are short term. They don't tell us about longer term trends. They don't always work either. So if you're looking at patterns, that might work sometimes, but it's very one-off. Trends are something that you might want to look at more. Trends are more easily identifiable. So let's come on to trends. Chart trends can help us spot a possible trade. Definitely. We can't trade from patterns all the time. It's just not possible. But trends will guide us more often. And if we can find, not force, but if we can find the trend, then we can